Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group. I want you to take just a few minutes and join me here for our monthly economic update. Last month, Jason Newcomer, one of our CFPs, and I talked to you about how we thought volatility was bound to creep back into the markets. And as of the time of this recording, the markets are now 2,000 points plus below where they peaked out earlier in June. Stay tuned. Okay, let's get started with what's going on in all the major indices. What I want you to notice as I go through some of these charts today is the big divergence in performance. We have some sectors that are doing good, we have some indexes that are doing good, and then we have some sectors that are doing absolutely horrible, and some indexes that are also doing absolutely horrible. Let's start with the latest 1 month, and we're just going to look at not all of the indexes, but we're going to look at a few of them here. The best performing index in the last month is the NASDAQ Composite. You can see that here, NASDAQ being up by almost 6% in the last month. Now we get the S&P 100, we're up slightly 1.6%. Let's drop down to the S&P 500 and the Dow Jones Industrial Average. Both of those are essentially where they were a month ago. And that was after the big surge that we got those last couple of days in May into that first week in June, and have since fallen back. Now, we did see a big surge in the Dow Jones Industrial Average. It currently sets on a year-to-date basis down about 10% on the year. Let me pull that chart up for you here. So Dow Jones Industrial Average is sitting down about 10.69 on the year. Now, we only have one index in positive territory so far this year. That's the NASDAQ. It's up 14.63. Take a look here, and what you're going to see is the very worst performing index is the S&P 600 small cap, negative 21.84%. So we have a 35% spread between the best performing index and the worst performing index. You don't see that happen very often when you have a market that's super healthy and when everything is kind of going along and doing well. You're getting these big divergences. And I want to dive into some of the different sectors instead of just the indexes. And you can see a little bit more about what's going on in those sectors. And then we'll talk about what we think's coming up. We'll talk about COVID-19 just a couple of minutes. And then we're also going to talk about the upcoming elections in November. So let me group these by sector. And when I do this by sector, what we're going to do is we're going to start with energy. And in the energy sector, there are 26 ETFs that track the energy sector. The best performing ETF that tracks the energy sector is down by 30.64% so far this year. The worst performing ETF that tracks the energy sector is down by 60% so far this year. So there's a huge divergence just in the energy sector, but clearly all negative. Financials, we see a very similar story in financials on a year-to-date basis. And so in the financials, we have 27 ETFs that track the financial sector. Best performing ETF tracking the financial sector, minus 7.27. That one's kind of in loan territory. You get down to the third or fourth one and you're seeing minus 20, but the worst performing ETF in the financial sector is down by 89.32%. Now, keep in mind, that is a ETF that does 3 times what the financial sector does on the upside. So if the financial sector is losing, it's going to lose 3 times as much. Those are very, very risky. You don't want to have any money in those unless you are very confident that the markets are going up, and they are not for the faint of heart, trust me. Healthcare sector. You would think that everything in the healthcare sector would just be doing amazing. Let's look at a year-to-date on the healthcare sector. Best performing ETF up 26%. As we go down here, though, you've got ETFs in the healthcare sector that are actually minus, the worst one, down by 20%. So again, there's a big divergence. Not all the stocks in the healthcare sector are doing well, and the ETFs that are focused in the right place are actually performing pretty well in the healthcare sector. The industrial side of things, that's going to kind of go along with what the Dow Jones Industrial Average is doing, but on a year-to-date basis, we can clearly see that in the industrial sector, the best ETF is down 3%. worst performing, minus 27. So again, huge divergences there. Don't need to go through all these, but check out technology. So technology is the one, when we look at this on a year-to-date basis, you're anywhere positive from 26% to the worst one. You got some bad ones in here too, minus 72%. So there are some things that you need to be aware of and some things that you need to kind of stay away from. But the point that I want to make to you here is that we don't have, even in this last quarter, which has been historic in terms of the returns, this isn't a broad-based market movement where you're seeing everything rise. It's only certain sectors that are holding the markets together right now. And really what we should take away from that is that we still need to be exercising a good degree of caution. We are doing that every single day, obviously, watching very closely as we see COVID-19 cases start to accelerate again. And really, that's a big unknown to the markets. The markets don't like uncertainty. We talked about that last month. There still is that uncertainty. We haven't heard much in the news in the last few days about any additional new treatments that are out there, or not a lot going on and talking about any of the potential vaccines and the trials that are going on with those. If we get that, if that happens, then I think it's going to be off to the races, because we're going to get to see the economy fully open back up, people going back to work, but we have no clue when that's going to be out there. So that's a big uncertainty between now and the end of the year. The other one is the election. And it doesn't matter if you're Democrat or Republican, the markets today don't like Joe Biden. They do like what Trump's done with the economy. Now, from a social issue standpoint, they like Biden better than Trump. This is going to be a very heated political environment, and I expect the gyrations that are starting this summer in the markets to continue. At this point in time, I don't see any reason to, run to the sidelines or flee. We've got most of our indices are giving us a green light, saying it's, good times are still there right now, even though the volatility is here. I encourage you, though, keep your line of communication open with your financial advisor. Understand what's in your portfolio, understand how it fits into your overall financial plan, because our goal, as always, is to make sure that people can get to retirement and through retirement and do it with a high degree of confidence. If you have questions, let us know, give us a call, send us an email, and always make sure that you share this with your friends. If you're watching this on YouTube, give us a thumbs up, follow us, and subscribe to the channel. We want to wish everybody a very happy 4th of July, Independence Day. Hope everybody stays safe, and look forward to opening back up to where we can start seeing people in the office again. Take care.